The CNBC app. Global market news in one place. Customizable sections and personalized alerts. Stocks tracking, interactive charts and market insights all in your hands. Stay connected. Stay informed. Download the CNBC app today.
A very warm welcome to, I think it's Friday. It is Friday. It's the Friday edition of Squawk Box Europe. Some say it's the best. I'm Steve Sedgwick with Juliana Tattelbaum, and these are your headlines. It's a beat over at Netflix. The streamer raising revenue guidance, citing healthy member growth and ad sales. Shares just slipped a couple of percent in extended trade as investors focus on rising costs in the second half. Well, the Fed Governor, Christopher Waller, who we can neither confirm or deny, could well be a potential at some stage replacement for the current Fed chair, he's pushing for a rate cut this month as he sounds the alarm over growing weakness in the labour market.
And Japan's ruling coalition is seen losing its upper house majority in this weekend's election as a right-wing upstart party risks putting increasing strain on the country's finances.
Good morning, Juliana. How are you?
Very good morning. I'm pretty good on this Friday morning.
You look with trepidation about what I'm going to say next.
Well,
no, all I was going to say is, already today, it's exciting because there are a couple of companies that trade at massive premiums, 40-odd times forward. Netflix, yeah, we can talk about that. We will talk about it. Trades at 40-odd times forward. And one can think about many reasons why one could justify that valuation. But Burberry trades at 40-odd times forward as well. Is there any rationale at all why this one is primed for recovery?
Well, there's a major turnaround story underway at Burberry. The CEO has been in place for about a year now, and investors have been putting more and more money behind this stock this year. It's been a key outperformer in the luxury space. The stock is up 28% year to date compared to LVMH, the behemoth in the luxury space, down 25%. So this is a story that the investment community increasingly likes. The momentum has been quite positive into today's numbers. Now, in terms of the update, we've got the first quarter trading update just coming through now. Q1 comparable sales growth down 1%. In terms of the margin story, Burberry says we will deliver margin improvement with a continued focus on simplification, productivity, and cash flow in the fiscal year 2026. Now, the company, in terms of the commentary, saying over the past year, we've moved from stabilizing the business to driving Burberry forward with confidence. The improvement in our first quarter comparable sales, strength in our core categories, and uptick in brand desirability gives us conviction in the path ahead. Here is the company talking about how they are trying to focus on improving their product range, pricing, marketing, refocusing on their British heritage. That's the qualitative piece here. It's
great, isn't it? Comparable sales down 1%. Yeah, we're having a laugh on this one. It's up 27% this year. It's trading at 40. It's trading at a higher PE multiple than Netflix, and the sales growth is down 1%.
The luxury space has been a tricky one, and
it
has fallen out of favor.
I agree.
I think in terms of the outlook here, let's take a look at what they're saying for the fiscal full year 26. Outlook. We are still in the early stages of our turnaround, and the macroeconomic environment remains uncertain. Our focus this year is to build on the early progress we've made in reigniting brand desire.
Yeah, they have. First quarter retail revenue down 6%. Wow, look at that reignited love.
It's a fair point, and they are coming off of a low base. This is a stock that had struggled under the previous CEO, and it is all about the turnaround story. And if you are bullish on this stock, you're going to want to look at the encouraging comments around the future, but clearly this is a company that has struggled. Comparable retail sales, though, improved sequentially in all regions. EMEA grew 1%, boosted by local spend, offsetting declines from tourists. That's interesting. Americas grew 4%, supported by new customer growth. Greater China, and this is an interesting piece we've been tracking with all the luxury names, Greater China decreased 5%, with mainland China down 4%, Asia Pacific overall down 4% with challenging performance in Japan.
I'm obviously playing devil's advocate to you today, and I hope you appreciate the role I'm playing. I mean, I'm a proud Brit. I want to see British companies do well. But the fact of the matter is, there is a trading style out there, whereas if you're looking at whether it's growth or value, it can transcend both. And if you ignore momentum, ignore all that, is pick the best in class.
Yeah.
If you, and it's a long-term, Buffett-like scenario, or Terry Smith or someone, some of the big investors out there, pick the best in class. If you want to pick a thematic, you want to pick luxury, you want to pick on China recovery, you want to pick on retail looking good as well, pick the best in class. And there are unbelievable names out there as well. We've talked a lot about with Charlotte and yourself and that. And so you've got your Kerings with your Gucci's, you've got your Hermes, you've got your Louis Vuitton Moet Hennessy, you've got your Bruno Cucinelli, can sell $1,500 jumpers to the likes of Arjun, who's sitting there quietly ready for the next segment. He's not even on set, he's not even here. Morning, Arj.
Morning.
And the fact, you're not even here. I didn't introduce you. But so why would you pick Burberry? Well, you pick it for the recovery because you think it's recovery. And I'm sorry, this is a stock which looks priced very, very highly for recovery already. So what's in it for that lot out there? This amazing bunch of viewers who watch us every day.
Well, let me add to.
No, you're supposed to detract from it. This is what we're playing today.
I think number one, I made the case already for why you would be buying into Burberry here. The momentum has been really positive, but why might you be cautious? Because of positioning, because as Luca Socco, who we're going to be speaking to later in the program, has said, luxury has really turned into a trading sector this year, and a lot of the fast money has gone behind Burberry. So I think the momentum has been really positive into this, which means expectations high. So I don't know if this is going to be enough for the stock to continue higher for here, but I think in terms of the turnaround story, you want to see them encouraged about the future. They are saying the external environment remains challenging, so clearly trying to toe the line quite carefully.
Can I tell you something as well?
Yeah.
I'm old, of course, but I remember when this sector was called fashion before it called itself luxury, and it is still fashion. And one should never forget that yes, there are some classic items. Your Birkin bag will never go out of fashion. There are certain items which will always be, but most of this stuff is you're in fashion, you're out fashion. You have a good season, you have a bad season. And a lot of our viewers forget about that. A lot of investors forget about that luxury. It's not just luxury's doing well, luxury doing badly. It's have you got the zeitgeist of this sector at the moment? And very often, a lot of these companies miss it as much as they get it.
Well, let's wait for the conversation with Luca to hear his thoughts. We'll flesh it out a little bit more, but now let's push on. You got a little glimpse of Arjun, who's standing by. He's going to be with us now to talk Netflix. The company beat top and bottom line expectations in the second quarter as subscriber and advertising growth, new content, and a weaker dollar boosted revenues. The streaming giant raised its revenue guidance for the full year, now forecasting around $45 billion compared to around $44 billion previously. But those results weren't enough to boost shares in extended trade. One note of caution in the release coming on costs, as the company said operating margin would fall in the second half due to content write-downs and expanded marketing costs. Netflix has expanded its slate of live sport and entertainment programming, including boxing, the NFL, and Arjun's very own favorite, WWE wrestling. Co-CEO Ted Senderos was asked about the firm's sports strategy on the earnings call.
Our live strategy and our sports strategy are unchanged. We remain focused on ownable, big breakthrough events because our audiences really love them. Anything we chase in the event space or in the sports space has got to make economic sense as well. We bring a lot to the table, and the deals that we make have to reflect that. So live is a relatively small part of the total content spend, and we've got about 200 billion view hours. So it's a pretty small part of view hours as well right now. But that being said, not all view hours are equal. And what we've seen with live has outsized positive impacts around conversation, around acquisition, and we suspect around retention.
Now let's get to our WWE fan here, Arjun, who I think was up late watching, if I'm not mistaken. Arj, you did make time to listen to the earnings call, look at these Netflix numbers. It feels like expectations were pretty high going into these results. And yes, they delivered a beat here, but the stock still struggled. Is that simply because it's had such a tremendous run so far, so the bar is now high for what's going to catalyze further gains?
Yeah, I think that's one of the reasons it's had a 40% run up this year. Steve was talking about the forward PE valuation as well. That is a big question of where this stock is valued. But I think there's two other points here as well. The guidance raise, while positive, of course, they attributed that primarily due to FX rather than sort of the underlying business. So that was sort of one part of the guidance raise. The second part was them talking about operating margin being lower in the second half versus the first half. So, given I think the run up in the stock, the expectations were high, it needed a little bit more to push this stock up. But I don't think, very small move compared to what we've seen in the past with Netflix. I don't think this fundamentally changes a lot of the bulls' conviction about where Netflix is heading, that it is, they say, the best-in-class stock when it comes to streaming, and that this content slate has a huge breadth. And that, I think, is a big part of what Netflix has done. It started with these series. It started with third-party content. It's been investing heavily, and we've seen over the years the billions it's invested into content, into these big shows that have gone global now, and now expanding into sort of more local content and live events. And so it's about that expansion of content that has been key for Netflix, I think, and why people are supporting this so much.
What's happened to the also-rans dropping out of this sector, or is everyone just hanging on in there regardless of cost? Because we've talked a lot over the last couple of years about the fact that there is a multitude, a plethora, another one of my favourite words, I probably use quite a lot on the channel, a plethora of options on the streaming front as well. Are households actually absorbing all these costs or cutting back at the periphery?
I think we saw Peacock actually raise their prices about $3.
Peacock, which is part
Comcast
of this, our group.
Absolutely, and they raised prices. So it is, they're hanging in there. I think there are some success stories. We've seen, Amazon have some big shows, and we've seen Peacock have some big shows. But I think for now, Netflix has really solidified its sort of leadership in the space because of the way it's gone after multiple avenues of content. The competitors are still very much there, but Netflix appears to be managing to continue to grow revenue, gain subscribers, and I think part of that is the pricing strategy. We saw them cut down on borrowing accounts. The ad tier has helped a lot. It's still a very small part of the business. Don't break out numbers, but they say that they're expecting ad revenue to double this year, so that's been a key part of the story as well. And of course, the multiple tiers has allowed them to get audiences in different markets as well.
You mentioned their content strategy, and Steve and I were talking yesterday about F1, which is this blockbuster film from Apple, and Apple's strategy seems to be at this point about releasing in a slow way some major hitters, but not a constant stream. That's a totally different strategy to Netflix, right? In terms of their steady release of content. They are all about a steady drumbeat, I think the company said. Just flesh out how that content strategy is working compared to the likes of Apple.
Yeah, and I think that's probably the right strategy for Apple. Remember, of course, Apple's main business is the iPhone and the other products, and the shows and films they produce are part of that broader services category, right, which is critical to keeping their users stuck in the Apple ecosystem. And so they don't need to have massive hits every week or every month. They can go on this sort of slow burn. And Netflix's core business is making sure people continue to subscribe and continue to go up the tiers, even if they're on sort of a cheaper tier of platform. And that's where this content becomes key. We know sports is an area that people are very keen to pay money for. They're happy to pay money for sports. And so you're seeing Netflix begin to dip their toe into that, even after years of saying we're never doing live sport. But it's I'd say a kind of three-pronged approach. The live sport is key, and you've seen a lot of engagement with those. They've had boxing, they've had WWE, they've had a few other events. I think they've got NFL later this year as well. Then you've got this, what they call local for local strategy, i.e. trying to create local content in a market for those local consumers, and they've bought the French TV channel TF1 to effectively stream their linear TV channel on Netflix in front.
Okay.
And just finally, very quickly, Steve, they're making
not me,
local
it's Will,
content.
The director who's pushing you on. It's not me. Don't blame me.
Just find local content that goes global. Think Squid Game, Korean show that has got a global following. And so that's where they're attacking from the content strategy.
Right. Okay. Thank you very much indeed for that. Lovely to hear they're doing live sport and live wrestling as well. Fed Governor Chris. Well, it's true.
Don't blame entertainment.
Oh, that's
sports
it.
entertainment.
I call sport. Sorry. Fed Governor Christopher Waller has called for a rate cut at this month's meeting. Waller, who is widely considered a candidate to replace Jerome Powell as Fed chair when his term ends next year, if he makes it that long, said policymakers should look through tariff effects and focus on underlying inflation, and that slowing momentum in the US economy justifies policy easing. Waller is an outlier on the FOMC for now, and traders still see a July cut as highly unlikely, with markets pricing around a 2% chance of a move lower, according to the CME's FedWatch tool. Quick look at the US markets and where they close. Actually, for the week, there's some quite interesting moves. I'll just run you through that quickly. For the week, the Nasdaq's up 1.5%. The Dow is flat as a proverbial pancake. In terms of dollar crosses, You like that one?
Yeah, I like that one.
Okay, good. Doesn't matter which kind of pancake, but it's flat as a proverbial pancake.
Flat as a crepe.
Dollar crosses, here we are. Actually, the dollar, we all this talk about the dollar decline. It's actually up 0.8% this week as well. So a little bit of a retrenchment there as well. Asian indices are thus performing, and we're going to get out to Kari and Joji talking about Japan in a very short while and the political ramifications there. Down 0.2% for the Nikkei. So here we go. Japan's ruling coalition is at risk of losing its upper house majority in elections this weekend. The economy is at the heart of the debate, with opposition parties calling for tax cuts and more spending, raising questions about whether the government can stick to fiscal discipline. The rising populist party Sansaito, which uses the slogan Japan First, that sounds familiar, yes, in an echo of US President Donald Trump, is currently polling in third place. The right-wing party takes a hard-line stance on immigration and has criticised the BOJ's quantitative tightening plan. Again, I'll take another look at some of these Japanese markets and where they're currently trading. Pretty calm stuff, actually. The 10-year yield, 1.5%. Well, Kari is, of course, our go-to on this one. Kari and Joji joins us now from Tokyo. Lovely to see you.
And you. I was going to start off with the elections, if I may. I think that usually this is just a pulse check, but this time is completely different. It's going to be a referendum on Prime Minister Shigeru Ishiba, and the voters want to tell him how they think he's been doing on the price front. The price of rice has doubled in the last year. This is the first and foremost issue for voters when they go to the polls on Sunday. And you mentioned the far right. This is the party called the Sansaito. I mean, I don't want to get too ahead of ourselves, because at the end of the day, even if they do better than expected, it's not in a position where they're going to take over the government. So I just want to make that clear. But immigration is also first and foremost as part of the in terms of voter polls, and that's what they're interested in. This is kind of an interesting part. It was fringe. It started 5 years ago during COVID on this anti-vaccination drive. They're now anti-immigration. They're now anti-globalization. And as you pointed out, it's a similar rhetoric that we heard in the U.S. and other European countries as well. The point is that Japanese voters are increasingly, if you believe the polls, likely to give the thumbs down to Prime Minister Shigeru Ishiba. The magic number is 50. If they don't get 50 seats, that means they lose the majority in this House. They are already lost the majority in the other House. That means it's going to increase calls for him to step down. And it couldn't have come at a worse time, because the trade negotiations have been at a stalemate. The Treasury Secretary, Scott Bessent, is in Tokyo right now. In about 2 hours' time, he's going to be making a, courtesy call to Mr. Ishiba, but no one expects any kind of breakthrough there. And I think with the goalposts continuing to move, it makes it very difficult for Japanese industry, particularly the auto sector. And we already know that the giant like Toyota can no longer absorb these costs, and are going to start raising prices in the United States.
Thank you for bringing us the breakdown. I know a lot at stake heading into the vote on Sunday. Coming up on the show, the U.S. House passes a landmark stablecoin regulation bill and a boost for the crypto sector. Plus, we'll bring you some insight into President Trump's social media activity and what it means for investors. And Yara reports second quarter results. We'll speak to the CEO, Sven Tor Holsether, after this break.
Okay, European futures, they look pretty positive at the start of trading today. Right, let's straight away get to another big European company reporting. Yara's second quarter profit has surged. The Norwegian chemicals maker, fertilizer business, reported better margins and record production. Wow, adjusted EBITDA rose 27% on the year to $652 million. And that came in just shy of some analysts' expectations, but I really want to get to Svein Tore Holsether, who's the CEO of Yara. Svein, we've talked enormous amounts over the last couple of years, and I've loved every one of our conversations about the problems in the industry. That said, the market seems to think you're overcoming all those. Your shares have had a great rally this year, up 28%. Your numbers this time round look incredibly solid to the upside, albeit, as I say, some of the estimates were even for more. Just tell us about the landscape, sir.
Well, I mean, we're showing another quarter with continued improvement in our EBITDA, 27% that's increase, as you said. And we see that across our company, we're performing really well on finished goods production. We launched our cost reduction program about a year ago. We're ahead of plan. Same thing with the CapEx optimization. We're ahead of plan on that as well. On emissions, we're on target on that. So it's another quarter with a solid performance. Our return on invested capital is at 9.9%. So we're still not at our 10% target through the cycle. So while we're pleased to see the progress, we're not yet where we want to be. So it will continue to focus on further improvements in our financials and also operational.
Svein, I read a great article that you made just a couple of weeks ago, I think, where you were speaking to the FT, and you made the comment, which you've made before, the food system is fragile. Just explain to our viewers a little bit some of those tensions, because every single one of these devastating global conflicts, whether it's the Russia-Ukraine war, whether it's problems in the Straits of Hormuz between Iran and Israel, etc., they all affect this fragile system.
Well, with what we've seen in the last few years, we see how incredibly fragile the system is. It started with COVID, where we see, it's a global system. It's been optimized over decades, but it's a very complex system. And when supply chains start to get into trouble, then that spills straight into food prices and food availability. And then when one food superpower, Russia, attacks another food superpower, Ukraine, that spills straight into the food system. And in order to produce food, you need energy, and it's not strange because energy is also how we as humans get energy is through food as well. So it's all connected, and when this starts to be volatile and when energy prices increase, it spills straight into the food system. Right now, food prices are lower. It's good to see we have good crop yields across the world, but it is still vulnerable. And I was in Ukraine 3 weeks ago, and I saw it firsthand. How the Ukrainian farmers are really at the forefront of food production, and how they're out there in the fields in the most difficult of circumstances to produce food. But it is difficult, and even if they've been able to keep food production at an incredibly high level given the circumstances, it is reducing. So when I look at total food production, grains and oilseed in Ukraine in 2023, that was at 78 million. In 2024, it was at 73 million. So it is decreasing. It is tough in Ukraine, and we know that 400 million people are food dependent on Ukraine. It says something about how fragile this is, and that we need to be aware of also the geopolitical risk in the food system.
Sven, you mentioned the launch of your cost and capex reduction program, which you announced back in 2024. You've now reduced your capex guidance slightly for 2025. In terms of portfolio optimization, should we expect any further divestments or restructuring within your portfolio?
Well, when it comes to cost reduction, that's for us business as normal. We will continue to work on optimizing both our cost base, our operations, looking at our portfolio as well. So that's an ongoing work that we will always look at. But indeed, we have made significant improvements in our cost in the last 12 months. Manning is down by 1,400 compared to where we were a year ago. And we have the curtailed operations and the shutdown operations as well as a result of demanding market conditions. But it's also good to see that through these measures that we've taken, and many of them have been difficult, of course, but still to be able to see that is materializing also into improved margins, that's good. So for us, this is ongoing operations and ongoing business.
Let me Wrap up with a question on nitrogen markets. Clearly, a lot of your business is dependent on urea prices. Talk to us about the supply-demand balance and what the outlook looks like for the second half of the year. It seems like a lot of uncertainty still around Chinese exports, which have resumed.
Yeah, we've seen a lot of volatility also in the quarter that we've been through, because also the Middle East is a big producer of nitrogen fertilizer, and the Strait of Hormuz, I believe about 40% of traded urea goes through the Strait of Hormuz, and then also with the impact on gas fields in Israel supplying the Egyptian producers, what happened in Iran also on production. So there are many elements here going into the nitrogen part of the business as well as also the natural gas side. Then when it comes to China, after a year of not exporting last year, they have committed about 2 million tons of exports so far, and they might increase that. At the same time, we see that India is increasing their imports, both because of strong sales of nitrogen products, but also some of lower production and lower ingoing inventories, which is helping to balance the market. And what we're seeing now is very strong market fundamentals with a demand-driven market for nitrogen.
Sven, thank you for taking the questions. Great to have you on the program. Sven Tore Holsether, CEO of Yara. Coming up on the program, Burberry wraps up the first quarter on an optimistic note, flagging early signs of recovery despite slowing comparable store sales. We'll have more next.